Okay, welcome to the intro class 111 at DePaul University for February 19th. This evening there's a couple things I'm going to be doing, and I did add some material to the previously submitted content. So when you see some slides that I've titled Life Insurance / Annuities 101, if you want to print them out and use them for later on, you can do that. I've had a couple questions regarding quiz assignments, and I want to be very clear. The quiz assignments are due. If you don't get your quizzes done because you're working on the midterm right now, the quizzes will be open so that you'll be able to get them done a little later. That's fine. The other thing is you have quiz 5, you have quiz 6. Many of you have already completed or are working on quiz 5. Quiz 7 will encompass both units for next week, the Monday and Wednesday. So in effect, there'll be a 20-question quiz. It's not going to be due until after we complete both sessions. One of your colleagues sent me an email that for some reason the midterm was not up where it was supposed to be so you could submit it. The midterm is to be submitted the same way as the quizzes. And I believe if it's not up now, it will be up by tomorrow. And because of this, I'm going to extend the due date from Monday the 24th to Wednesday the 26th at noon. Therefore, if anybody was trying to do it and you were all frustrated, you have a couple extra days, you will get an email about that. I want to refer to a couple questions. A couple people emailed me about some of the time value of money problems, and I've emailed back to you with the information. One of you, I'm still looking for some additional problems, and I will get that to you. Quiz number 4, question number 1. Quiz 4, question 1 is referring to, under the IR, Internal Revenue Code, what is deemed to be alimony. And one of your colleagues asked a very good question, saying that one of the answers didn't specifically say alimony or child support. Well, if they want to know if it's alimony and child support, they're not going to specifically say that. And the way these questions are worded, we've tried to make them as similar to the comprehensive exam as possible. There's no such thing as a perfect exam or perfect quiz questions for everything. So if you refer to the appropriate slides, it said that for alimony the payment had to be in cash, or it could be paid to a third party for tuition, medical bills, mortgages, and so forth. It said that if you're still living in the house or the house is still yours, that doesn't qualify as alimony. And one of the situations said that it's still titled to him. So the best answer was the fact that the gentleman was making payments of so much per month until a specified date for the child, which is exactly what it says on the slide, that if it's tied to a specified date, then it's not alimony, it would be child support. So this was the best answer here, quite frankly, was the one where payments were being made to a third party that was one of the eligible parties. The other question I want to go over is something I really don't know what's going to happen based upon the Affordable Care Act, and had to do with the COBRA benefit. Let me find the right question, please. Question 3 on quiz 4. Currently, if a company has more than 20 employees, full-time employees, that would qualify them for COBRA under the Internal Revenue Code definition. And according to some of this question, even said, because, not some of the question, the answer stems, because in terms of hours worked, they had the equivalent of over 20 employees. That is the way we understand they're going to be interpreting it right now. There's what's being said, so be aware of that. And I believe those are the questions. On question 5, I'm sorry, quiz 5, there's a question, number 1, that I have a problem with, and one of the other instructors is insisting on leaving it in because it's a good question. If you go and try to find the term attitudinal hazard, you're going to have a hard time finding it. It's not in your textbook, and it's not in any of our material. But quite frankly, when the question says Cindy is so excited about the 75% off sale that she didn't lock her car doors when she parked the car in the mall, this would be an example of attitudinal hazard is not listed, but apparently it was in another textbook that somebody else was using, and the way the CFP comprehensive exam is, if they can identify 1 or 2 sources, they'll allow the question. So I actually put in attitudinal moral hazard, which I'm telling you right now is the correct answer. Question 5, I'm sorry, quiz 5, question 3. The first step in risk management is to identify the risks. I've had a lot of people complain about that question based upon what's in the Vaughn book, which says that's the second step. But based upon the way we discussed it in class, identify risk would be the correct answer. Therefore, you have a couple, somebody's sending me a question. Question 1 is C, not A. Okay, which quiz are you referring to, please? So I've given you a couple free questions, so when you go to complete the quizzes, you'll have them. No. Question 1 is C for quiz 5. Okay, so one more time before we start the actual material. The midterm will be due a week from today, Wednesday the 26th by noon. That gives you a few extra days in case somebody was trying to get on. You do not have to email or do anything else. It's going to be there. Now, let me explain how I'm going to operate the class tonight. The slides, the first 45 or 50 slides are on the insurance industry, which is material you already have. After that, I'm going to take a short break and do the intro to insurance, which I have found has helped a lot of students. When you're reading the Vaughn book and doing the rest of the material, you have a better understanding. I need you to understand, please, I do believe strongly that people, as a risk management tool, should have insurance available to them for all kinds of things. Life insurance, property casualty. I'm a big believer in insurance. I'm not saying that term insurance is good, and I'm not saying that whole life insurance is bad. I'm just talking in terms of what the purpose is of the product. So, there are different types of insurance companies or categories of insurers. I'm on slide 2, unit 6. So, one would be a stock company. That's where you have stockholders. It's traded either on the NASDAQ, over the counter, or in New York or American Stock Exchange. The capital is provided by the stockholders, i.e. the shareholders, and they're the ones who assume the risks. If the company doesn't make a profit, they don't have a profit, and they have no dividend. A lot of the insurance companies are stock companies, but the other kind is a mutual company. And prior to the late 1970s, there were many, many companies, there were mutual companies that determined it was in their best interest to demutualize in order to provide a way to get more capital and growth. Mutual companies are owned by the policyholders. So as people buy insurance, they end up becoming a policyholder and an owner of the company. If there's any money left after paying claims, that money is distributed to the policyholders, usually via the mutual dividend. Dividends for mutual companies are different than dividends on stocks in the way they're taxed. So, and I'll explain that to you as we get into the material. Dividends that are paid to policyholders are considered return of excess premium that wasn't needed. The mutual companies, it says here, there has been a trend toward demutualization. Demutualization. That started in the late 1970s as companies such as the Equitable Society, the Prudential, the John Hancock, MetLife, all of these large mutual companies determined that in order to grow and raise capital, they had to demutualize so they'd be able to borrow money and grow and become bigger and stronger companies. Prior to this demutualization, there was a huge, somewhat controversy in the insurance industry because people would say you only want to have policies from a mutual company so that they're going to be run better and you have a better opportunity to participate and they're going to be paying more attention to the money as they spend it. The stock company said, no, you want to be with a stock company because what really happens is they're going to pay more attention because they have independent boards and everything else. What's happening now is most people don't care. There still are mutual companies. New York Life and The Guardian are still mutual companies. Nationwide Insurance, State Farm Mutual are still mutual companies. And the business model the company decides to use has really very little bearing any longer on whether it's good, bad, or indifferent. There are several other kinds of insurance companies. Most of these you're not going to see very often. I'm on slide 3. Reciprocal exchanges, those are inter-insurance exchanges, and a lot of that is in property casualty. Each member company is both the insured and the insurer in that they buy into it. They put up their own capital. It's like a self-insurance situation. Is somebody trying to ask me a question? Is someone trying to ask me a question? I can't hear it. Hello? I guess not. Lloyd's of London is an association of individuals and companies now where they guarantee to honor claims. Usually it's specialty things like oil tankers. They've insured Betty Grable's legs. They've insured Liberace's hands and his smile. They do specialty underwriting. Health insurance associations are really not companies. Blue Cross Blue Shield and HMOs are associations. And then if you think about it, the U.S. government has insurance. The VA, the FHA for mortgages, the National Flood Insurance Program, and if you also want to think of Social Security as a large social insurance system, that would also be there. Certain companies and certain marketing programs function differently. And the way a company determines it's going to market its product has no bearing on whether it's good or bad. By that I mean some companies are direct underwriters through the internet or TV or the phone, and have been for many years, such as Geico, Progressive. They also now have agency systems where what they have is people in the system that represent that one company. Sometimes they can represent more than one company, but typically your Allstate agent, your State Farm agent, your Geico agent, they're really representing one company. And usually they can solicit and deliver the insurance through either a territory or in some cases anywhere in the country. The agency system in life insurance, it says you usually have a general agent with sub-agents that will report to the general agent, and the general agent will get some kind of an override based on the business that's being written. In the property casualty world, it says that the agent can modify contracts within certain restrictions. What we're going to be discussing now is legal terminology and legal issues. I know I have some attorneys in the class. I am not an attorney, so if you want to correct me on something, please do. The reason we're going to be discussing some legal terms is because, well, actually, I hope you don't have to correct me, come to think of it. The reason we're discussing legal terms is because if we're talking of agency relationships or agency law, where it says one person will act on behalf of another, it's important to understand that in terms of how insurance companies pass liability or maintain liability for their agents versus brokers. It's important to understand that when you go to take a securities exam, because some companies will act as a principal, which means they will get a markup or a markdown on certain investments, and otherwise they're acting where they're going to be getting a commission, but they can't get both. When we're talking about agency law, we have to remember that the acts of the agent operate under the authority of the agency or the company. That's where the relationship is. If you work for a large bank and you're a lending officer and you have the right to guarantee loans up to $10 million and I'm trying to borrow money and you tell me I have the loan, I obviously am going to say, well, wonderful, I'm going to rely on your situation and say you told me I had the loan, I can rely on that, I'm going to start expanding my business. If on the other hand it doesn't work out that way because you made a mistake, your institution is liable for the mistake you made. So what we're talking about here is how does authority pass from the individual through the company, and what kind of authority is it? And it says here there's express authority, implied authority, and apparent authority. This does get a little confusing. And express authority is something that is expressly stated or conferred upon the agent in the contract. If you are with a insurance company such as State Farm, Allstate, Nationwide, the people that are selling you the insurance are direct agents of the company. So when they say something, they're passing on the liability of the company specifically. There's more information in the Vaughn book, and I've given you pages to look at if you want further definitions. So under express authority, what are the powers that the agent is specifically given in their contract to conduct business? That's express authority. The next two, implied and implied authority and apparent. Well, let me just read them here. Implied authority. This is an authority that is not expressly granted, but it's somewhat assumed in order for me to conduct business. It may not be expressly granted in my contract that I can collect premiums, but if there is a receipt on the application, it's implied that I can do that. If there may not be expressly stated that I can advertise that I represent International Widget Insurance Company as an agent, but if I do it, it's sort of implied. So we have express authority stated specifically in the contract. We have implied authority, and I think it's a typo. Okay, you have to think of what is the intent. Apparent authority assumes the agent is acting properly. It shouldn't be expressed. It's a typo, I'm sorry. It should say apparent authority. I'm going to have to correct that. I didn't realize that until just now. So this should be apparent authority. Assume the agent is acting properly with no misconduct. Therefore, the agent is not acting in a negative or harmful way. Implied is looking upon the one conducting business in a positive manner. So apparent authority is, are you doing it in a negative manner, which is no, nothing you shouldn't be doing, or under implied authority, are you doing it in a positive manner? And I'm going to tell you that you're going to get a quiz question at some point where it discusses that a little further. Courts have ruled that the agent that has authority that the public has come to expect them to have. So what does the public believe? If you walk into my office and I have all kinds of signs that say, Agent for International Widget Insurance, I have applications and signs and brochures, you will be led to believe I'm okay for me to represent International Widget. If my contract was canceled, that still doesn't change the thing that there's an appearance of the fact that I'm acting within the scope of my responsibility. You're going to get some kind of a quiz question on this, and in one case, actually, I'm going to tell you right now, an answer is 2 of these. And the reason the answer is 2 of these is because a book we used to have had the exact same question as one, and the book we have now has the other. So I'm telling you, it's a little bit confusing. You're probably more inclined to get a question dealing with what is expressly stated in the contract. Slide 10. There is a big difference between, are you acting as an agent of the company or are you acting as a broker? Now let me explain this because it does get a little confusing. Agents represent the insurance company. They owe the insurance company their loyalty. They share the information with the insurance company, and they represent the company. In many cases, that's the only company they represent. That doesn't mean that they're not going to be honest and do a good job for the client. All it says is they represent the company, which means they will pass liability to the company, for the company, onto the client if there's some kind of a legitimate error that's occurred. Now, let's assume for a minute that you come to me and I'm dealing with International Widget Insurance, and it says I'm an agent for International Widget. And I tell you that you're bound over, your risk is bound over, and it's enforced because you paid the premium, you filled out the paperwork, and the way I'm reading it, there's no problem. And there's something where there's an accident or something that happened, you're going to rely on me and on my assurances that you have the insurance. Correct? Correct. If I am a broker, I'm representing many companies, and I can choose which companies to place my business with. Therefore, since I am not a direct agent of the company, I don't necessarily have to share all the information with the company, but I then am retaining the risk as a broker in case there's an error. Now, let's realistically discuss this. In the state of Illinois and many, in the state of Illinois and many additional states, there is no longer a term insurance broker. You're now called insurance producers. And the reason they've gotten rid of the term insurance brokers in the state, and actually now they've gotten rid of agents, is they just classified everybody as a producer. Because here's my question for you. I am selling one of you as a broker homeowners insurance for your $1 million brick home in a suburb. Your home sits on 2 acres of land. It's 5,000 or 6,000 square feet. Maybe it's close to $2 million if it's in the Chicago area. And the premium is $3,000 a year. And let's hypothetically assume I am making a 10% commission. Does it sound reasonable to you that I'm going to take all the liability upon myself if there's an error or anything else, and I'm going to be the one that if there's a problem that's going to get personally sued? Probably not. So even if I'm a broker, most of the contracts say that you are given agent's authority as long as you act within the scope. And that's what really happens in the world today, because no one wants to take that liability on. So for the real world, most people that are producers will only represent companies that if they are also given agent's authority. In the test world, there's a big difference between an agent and a broker and who has liability. If you're an agent, the liability maintains and stays with the company because you're representing the company. If you're a broker, you have the liability if there's a mistake because you're representing yourself. Now, are there any questions so far? Because it's important to understand these concepts before I move on. I don't see any questions being asked, so I guess I can move on. In the United States right now, there are probably somewhere around 1,800 plus life insurance companies and probably around 1,500 plus property casualty companies. Some of these are the same. There are certain companies that handle everything. And how do the people determine what company they want to work with. Well, in all honesty, ladies and gentlemen, the public determines what they want to do based upon price comparisons. Excuse me. And they determine what they want to do based upon what's competition and how effective and good the services they're getting. Premiums themselves have to be fair. They have to consider what the cost of the company is for producing the product. So number one, they have to worry about their losses and how much it's going to cost to process the losses. How much is it going to cost to acquire the business? The fees, the commissions, the medical exams, if it's life insurance or health insurance, possibly an inspection if it's property casualty insurance. What about the overhead of the business, paying their rent and their salaries? And of course, if they're making money, our friends at the IRS say, feed me, they have to worry about taxes. Companies have the right to determine how much profit they want to have on any given product or in their industry. Now, some companies are willing to work on a much tighter profit margin. Other companies want a larger profit margin. Some companies will say, we sell everything and we're willing to take a real narrow profit in order to move and do more in auto or homeowners, but we're going to try to maintain a wider profit margin on life insurance. That's a decision for the company. And if you remember, a couple of weeks ago we discussed the McCarran-Ferguson Act, which had to do with Public Law 15, where the federal government ceded the rights of the states to regulate insurance because as long as it was done in the public interest to promote competition, as opposed to under the Constitution for interstate commerce. So competition in the insurance industry says we need to have price competition, and we, the companies, will determine what we want to do. The insurance departments or the insurance regulators will be the ones that are then going to determine what's fair and if somebody is gouging. Now, in all honesty, I have seen certain property casualty insurance companies that sell all kinds of products have their term life insurance rates much higher than the more competitive term companies today. Maybe they don't want to sell the product. Let me give you an example. A friend of mine was with one of the large, well-advertised, well-known property casualty companies, and he called me up one day and said, can I look at my database and give him some information? I said, what do you want to know? He said, how much would $1 million of 20-year term insurance cost for someone at the age, I think it was 38, in really good health? And I looked it up and I told him it was around $900 a year. He came back and said, aha, that's why he's having trouble selling it, because this guy's obviously done some comparison shopping, and his company wants to charge like over $2,000. Well, in effect, what the company is saying is, we have this product on our books, but we don't really want to sell it. And if we want to sell it, we're going to be very expensive. Why do they do that? Because that's not their forte. Other companies are very aggressive in all forms of insurance. One I'm thinking of, actually two I'm thinking of, would be a Piece of the Rock and the Snoopy Company, where if you go and check them out, they're more aggressive on everything. That's just the way they want to do business. The other question is, how do they want to do business? Are they going to be an agency system? Are they going to be conducting business direct underwriters through the internet or television? Are they going to be having independent brokers? The way a company decides to do business is their own decision. Their marketing program really shouldn't be used to determine whether it's a good company or a bad company. The other thing I want to say is, don't get hung up with the only companies you should ever do business with are 100-plus-year-old companies that everyone's heard of. Because there are a lot of good companies that are smaller that you may not have heard of and have good ratings. And on the other hand, some of the very large companies, if you look at the history, sometimes they've had financial problems too. Insurance regulation, it says the main goal is to promote public welfare and to make sure things are fair for the public and to make sure there's competition and that the companies are financially strong. The insurance regulation is handled through the Department of Insurance based upon the various states. In some places it's called the Commissioner of Insurance, the Superintendent of Insurance. That's what it's called. Here is the slide on the McCarran-Ferguson Act. It is in your textbook. It's also referred to as Public Law 15. This law says the U.S. Constitution, under the clause for interstate commerce, has the right to regulate insurance because most of these companies handle interstate commerce. This law says we are ceding that right back to the states as long as the states regulate insurance for the public interest by providing for fair competition and providing for fair and equitable administration. So that's the McCarran-Ferguson Act. If you get a test question that talks about securities, the McCarran-Ferguson Act is only for insurance. Now this may change because under the Affordable Care Health Care Law, also referred to as Obamacare, now there's a national office or Department of Insurance to regulate health insurance people. So they may be changing that to go back to a national exam similar to what you would take for securities. But that doesn't mean you still may not have to be registered in your individual state. The federal government does regulate insurance indirectly through the tax laws, through COBRA, which is the Health Consolidated Omnibus Budget Reconciliation Act, and that's the act that says continuation of insurance if you leave your company. The Employee or Employer Retirement Income Security Act of 1974 regulates financial products and says you cannot favor highly compensated employees, you cannot favor the bosses. So and quite frankly, there's other laws that regulate insurance. I know this isn't the most exciting part of the evening, but I'm going through this because it is tested. I've already discussed this, that different states have different titles. Most of these are appointed by the governor. There are a few states where the people are elected, they're commissioners. The job of the insurance commissioner is to monitor and regulate the licensing of the different agents and brokers and producers. The job of the insurance commissioner is to make sure the tests are fair, competent, comprehensive, make sure that you have continuing education requirements that are met. In the state of Illinois, you currently have 24 hours of required CE every 2 years or every renewal period, and that 24 hours then also will include 3 hours of face-to-face live classroom ethics training. Now, in all honesty, there are some vendors in Illinois and all around the country that they have set a program together and have it approved with the CFP board, because the CFP board requires 2 hours of continuing education credits. So here again, you might find that there's a way that you can sit and take one CE on ethics for both, or you can do one online for the CFP board, and you can do the other one for the your state insurance department. The insurance commissioner also is to make sure now that the language in the policies is in very easy to understand English and not just legalese. The insurance commissioner also has to enforce fair competition. They have to make sure that the insurance is accessible to everybody and there's no discrimination, which means if you're a property casualty, they can't redline or say we're not going to write insurance in certain neighborhoods. They have to be fair. They have to make sure that they audit the insurance companies so that there are no insolvencies. They want to make sure that the companies are strong enough to be able to pay their claims. And quite frankly, as I've said before, I want the companies I do business with to be very profitable and strong, because if I have a claim, I want to make sure they can pay the claim. I don't want to be worried about the fact that they may not be able to pay the claim. The insurance commissioner also has rules and regulations that specifically state what you're not allowed to do. Let me explain these in a little more detail. In the stock world, churning would mean I'm buying and selling mutual funds or buying or selling stock that is very similar and might even have the same, if it's a mutual fund, it might even be a large cap and have primarily the same identical companies in it. But I'm doing it in such a way so that I'm not necessarily helping you, I'm helping me because I'm making new commissions. That's churning. In the insurance world, it's called twisting because I am changing the terms of what we're discussing. I might be embellishing certain things, I might be excluding certain things in order to get you to buy a new policy that's really not necessarily in your interest, but more in my interest. Such as, there was a time that people would have 2 and 3 and 5 Medicare supplement policies because people would say, my policy that you currently have doesn't cover blood transfusions, or it doesn't cover ambulances, or it doesn't cover surgery. So people would have more than one, and they didn't really need more than one. If they had the right policy, it would be covering more things. To say to somebody, your 20-year term insurance policy is not working right, you need to take care of it, you need to do something. Or, you know, this is 2013, your 20-year term insurance expires in 2023, why don't we get a super duper new plan? But they get you to apply for it, but you've had a change in health, so the premium is going to be higher, or you might be rejected when you have a convertibility policy on your current policy. So twisting is I'm changing the facts that's going to really benefit me, and I'm going to make a new commission. Rebating, and it says most states ban rebating, is saying, hi client, I'm going to give you some money back, or a TV, or tickets to the theater, or something of value if you buy an insurance policy from me today or this month. It's giving you an incentive that may not be to your advantage, because the incentive is going to mean you're going to be able to move forward and get something because you think you're benefiting. Let me give you an example. If everybody buys a new policy from me this week or this month, you're going to get a 27-inch flat panel monitor. Well, maybe the policy that you're buying in order to qualify for it is $4,000, and the monitor is only $160. But the other thing is maybe that $4,000 policy isn't the most competitive, or it might not be the right one for you. Because I might just say, if you want to get this rebate, or if you want to get this TV, you have to only buy this one product. And that might not be the right product for you. So be aware, churning is in the stock world, twisting is in the insurance world, rebating is basically a no-no. Insurance companies are licensed through the states. Before licensing an insurance company to do business, the commissioner is going to determine whether that company is solvent, has enough assets, enough reserves in order to do business. They're going to review the personal characteristics of all of the principals. They're going to make sure that they're honest and above board and have good reputations. They're not going to just let them go and start a company if they have, you know, a bad background check, or if they've been with other companies that have gone broke. I'm now on slide 18. The insurance companies must submit annual and quarterly reports to the insurance commissioner, and the departments will also conduct on-site examinations of their finances. And I have a problem here in today's world. Let me explain it. In today's world, one of the issues is a lot of the insurance departments all over the country, because of budget cuts and monetary cuts, have cut back on their auditing people. So where they used to audit the insurance companies based or domiciled in their states every second or third year, now they're probably not doing it every fifth year. And that's all because of budget constraints. Insurance companies are required to have reserves on deposit. Just like banks are required to have cash on hand for their claims, insurance companies must have reserves which would cover the liabilities that might occur. A claim. Cash value life insurance is a claim, is an asset of the person insured or the owner of the policy. It is a liability to the company because you can get it anytime you want. It says here that property and liability insurance companies may include premium income in the income only as it's earned. As it's earned. So if I'm paying my premium for my auto or my homeowner's policy annually because it's providing me a discount of 5 or 8 or 10%, maybe what's going to happen is I pay the premium, and let's say it's $3,000, I can only show that as an asset of my company each month 1/12. The other money is not listed as an asset. It's a claim against the company, so it shows as something different on the books of the company. Somebody has their hand up. Hold on a minute, please. Although a different industry, what about the auto insurance companies that try to incentivize their clients with cashback options if the individuals don't have accidents? Is that a form of rebating? Actually, it's a great question, and it's not a form of rebating because the company's doing it to everybody. They're not just singling out a group of people and said, if you want to do this, you're going to get it. That's part of their marketing program, so that's not classified as a rebate. That's why they call it a safe driver discount. Does that answer it? Okay. Did somebody else raise their hand? No, I guess not. Insurance companies might become insolvent. That means that they don't have enough cash to pay their claims. And it does happen. Back in the late 80s or early 90s, there was a 130-year-old company that was AAA rated. And this is before the internet. So the book was published, and I believe it was either Moody's or S&P had them AAA rated as one of the strongest companies in the country, and 6 weeks later they were insolvent because there was a run-on in their company because of the large amount of mortgage loans they had made in a certain part of the country. So companies do become insolvent, and if they become insolvent, the insurance department will try to rehabilitate them so that they'll be able to pay their claims. The insurance department will determine whether they can salvage it or do they have to try to sell it. One of the questions I'm frequently asked is, if a life insurance company becomes insolvent, what happens to the cash value? What happens to the death claim? To the best of my knowledge, no one has ever lost $1 of death claim benefit if the life insurance company has become insolvent because other companies pick up the slack. And pretty much so the same thing does happen with other insurance companies. And as an example, this large company that I just mentioned, when they went under, other companies bought their assets and took over all of their claims, and the only thing that changed is they said, we will continue to honor the increase in cash values as though you are our own policyholders, but since the previous company was paying a little higher rate, we're not going to honor that higher rate because we can't afford to, but we will give you the same rate we're giving our own policyholders. So people didn't lose their assets. After the financial meltdown of 2007-8, there was a boutique, smaller insurance company in the state of Virginia known as Shenandoah Life. It was a well-run, highly rated company for a long time. I think it was started in 1906 or something, and it was a family business. They weren't going to be a company that you're going to look at where it was going to say we advertise, and they didn't necessarily write million-dollar policies, but their niche was 100 to 250,000 term and annuities and some permanent life insurance. Unfortunately, they became insolvent because they had the worst of all possible worlds in their investment portfolio all at the same time. If you remember back to 2007-8, Fannie Mae and Freddie Mac both became insolvent, and people that had their investments lost. Lehman Brothers became insolvent, and people that had Lehman Brothers bonds lost. Their three biggest assets, from what I've been told, were Fannie Mae, Freddie Mac, and Lehman Brothers. So they had to go into receivership and be rehabilitated. We have been going for about 45 minutes. Do you want to take a 5-minute break? If you want a 5-minute break, give me a check mark or raise your hand. If you don't want a 5-minute break right now, put an X, please. Okay, it looks to me like the 5-minute break has it. I'm going to stop the recording. Let's reconvene at 21 minutes after the hour, and we will finish the next 20 slides and go on to the next session. So please be back in about 5 minutes. I'm going to stop the recording. Welcome back to the second session for tonight, February 19th. We are on Unit 6. Regarding insurance insolvencies, almost every state that I know of has some kind of a insolvency fund or safety net. So in the event insurance companies go out of business, it's like FDIC insurance, but except it's paid for by the insurance companies. And in the state of Illinois, it will guarantee up to $100,000 of cash in the annuity or in the life insurance policy. It doesn't guarantee any more than that, but as I said, death benefits and other claims have always been honored. The other thing I need to tell you about the insolvency fund is you can't go and use that as a selling tool. So if you're selling insurance, you can't go and say, but don't worry about the ratings of this company because there's an insolvency fund. You're not allowed to do that. The insurance departments or the insurance commissioners will approve the different forms and the provisions of the contract. We discussed those last week. The insurance departments will say what are fair rates. They don't say what you're allowed to charge, but they say it can't be excessive. Now again, I have an issue with what's excessive based upon the situation I told you where the company was charging more than twice what other companies were charging for term insurance. To me, that's excessive, but I can't go there. The insurance regulation of rates also says that you can't discriminate unfairly regarding any kind of neighborhoods or socioeconomic backgrounds. Life insurance companies, many states require the insurance company to provide buyers with cost disclosure information. Just so you know, to the best of my knowledge, you're not going to be tested on the Blythe formula or the other cost formulas or comparing the cash buildup of a life insurance policy to a CD. It's just not going to happen. But you do have to have some way of comparison so people can know it, and that's through the insurance commissioner's office. The insurance commissioners will also require that the insurers obtain approval prior to implementing rate increases. So they have to go and file the paperwork and justify why they want higher rates. It can be because of higher claims, lower interest that they can earn on their portfolio. And it says the trend is moving more toward an open competition model so that people can not necessarily have to go through the expense of filing paperwork. In all honesty, a lot of life insurance companies have changed, because it's very expensive to change the rates, they just adjust the underwriting process, which means if the super duper best preferred rate for life insurance was hypothetically $1, and in order to have that dollar per thousand, you needed to have a cholesterol rate of 200, and your blood pressure had to be 125 over 75. All they had to do was say the best rate now, you have to have a cholesterol of 190 or 185 or 180, and change. And what they've done is they can change the rates internally without having to go through and file all the rates, because that's very expensive. I missed a slide or two. Sorry. The National Association of Insurance Commissioners is an association of the insurance commissioners. It is not a legal entity. It has no legal standing. And they like to ask questions to see if you understand the difference between the NAIC and a legal entity. The NAIC is made up of the different insurance commissioners, superintendents, or directors of insurance for the different states and Puerto Rico, the District of Columbia, Guam, and so forth. They propose model legislation to help protect the public and provide for guidance and guidelines of how things should be advertised and what should be required. It does not enforce anything other than to make the recommendations, and then the state itself is required to have laws and regulations that will enforce it. As an example, the guideline model legislation proposed from the NAIC says if you're selling life insurance, you have to give a disclosure booklet of a buyer's guide. Almost nobody ever reads the buyer's guide, but you have to give it out. If you're selling a permanent plan of insurance, the illustration has to have certain information on the illustration and certain disclosures. Now, quite frankly, some of those illustrations are 27, 30 pages and no one reads them, but you still have to have them all there. And then on the illustration for life insurance, the insured and or the owner and or the agent has to sign the document as proposed, and if there's any changes to that document, even if it's changing the premium mode from annual to monthly, it has to be re-signed. The insurance companies have certain functions. They get to decide how they're going to make their rates. They're going to be using some actuarial tables, how they want to produce their products and what products they want to manufacture, how they're going to determine their underwriting situation so that you can determine what kind of policies you're going to accept. What is your loss adjustment? In other words, what is the ratio of losses to total policies in force that you're willing to accept, and what investments are you going to follow? Now, for the most part, most insurance companies have to be conservatively invested with mortgages and bonds and so forth, but they do have some flexibility on how they want to set it up. Rate making refers to the price per unit of insurance. So rate making is performed by the actuarial department. In property liability, they study statistical loss probabilities. For life insurance, it's a mortality table. For health insurance, it's going to be morbidity tables. And what are they going to consider? They're going to consider the cost of doing business, what it costs to manufacture the product, what it costs to pay people to sell it, either commissions or fees. What about other acquisition costs? What about their administrative expenses, premium taxes, contingencies, money for the reserves, how much profit do they want? All this is part of the rate-making situation. Now, depending on the kind of insurance companies have a standard risk. That's where most people or most buildings or most automobile drivers will fall into. Then if you have better than standard, you're going to have a discount. That could be preferred, super duper preferred, special preferred. If you're not as good as standard, it could be a surcharge. That could be a class rating. And that's what this is. And depending on the kind of insurance product will determine how that works. Many times insurance companies are going to be determining other approaches for how they're going to rate, such as if they're doing individual ratings, they're going to focus only on that individual. Have you claimed against your health insurance, as opposed to everybody that they've written. If they're going to be doing judgment, in other words, sometimes logic would say, according to the class rating, you should have this. I'm sorry, not logic, but the guideline booklet will say you should have this or that, but sometimes judgment will be a little different. I'll give you an example. Years ago, I had someone who was a non-smoker, and he tested positive for nicotine. And he said he worked in an office where 3 of the 7 or 10 people in the office all smoked, and they were allowed to smoke there. They actually went out and did an investigation because he said, I will sign an affidavit that I'm not a smoker, and they were able to prove that the reason nicotine was in the system was because of where he worked. Now, Today, that secondhand smoke would not be allowed, but I'm going back a long time. Scheduled rating starts with a base rate, and then they are going to adjust it. Experience, that's where someone has asked me about if you don't have an accident, you can get some kind of a bonus. That's more of a experience rating situation. Slide number 30. Insurance company production department, how do they want to do business? Sales and marketing, do they have their own agents? Do they accept brokers? Do they do everything online? How do they want to do this? And there's no real good or bad answer. Underwriting is a process that begins when someone takes the application. It's a process when someone starts taking the application. And the purpose of underwriting is to minimize adverse selection to the insurance company, and is to maximize the fact that you want things to be fair to everybody. Now let me explain this because it's misunderstood. I want the insurance companies I do business with to be profitable and fair. I want to know that if I have a legitimate claim, they're going to pay it. I want to know that in the event something is wrong, they're going to take care of it. On the other hand, I don't want them just to insure everybody at my super duper rate because I'm an honest, good person. I want to make sure that they're insuring people at what's fair. If I'm a car driver and I've never had a ticket or an accident in 10 years, it's not fair that someone who's had 3 tickets or possibly a DUI should be classified at the same rate I am. If I'm driving a Maserati for $200,000 or more and a sports car, it's not fair that I should pay the same, that you should pay the same premium as me if you're driving a Chevy Volt. If I am a professional athlete like Michael Jordan, who when he was in his prime, his fat body index was somewhere around 19, it's not fair that his life insurance premium should be the same because he's 32 years old as someone who's 300 pounds. So that's where the underwriting is able to adjust the premium based upon the amount of risk the insurance company is taking. Adverse selection means the insurance company does not want to have to guarantee to pay a loss. They don't want to have to guarantee to pay the claim. If you remember, recently I discussed the fact that if someone just became pregnant and they want to buy maternity coverage, that's a guaranteed claim to the insurance company. So they want to avoid this kind of adverse selection so that the premiums are fair to everybody. They will pay the claims that have to be paid, but they don't want to pay claims that they don't have to pay. The underwriting policy of the insurance company says, and sometimes you refer to it as a field underwriter if you're in sales and you go out and see people. Other times, the desk underwriter is the person in the office that's reviewing the application and seeing if it conforms to the guidelines of what they need to do. The application itself has all kinds of information: the name, the address, the date of birth, the social security number, what are they insuring, who they're insuring, what is your source of income, how long have you lived in your home, do you own a home? All of this is stuff that they ask on the application, and it's part of the source document. And then they will continue and ask additional information by going to credit bureaus, medical information bureaus, the Department of Motor Vehicle. They'll check and see what kind of claims you've had, and they may require inspections or exams. This is all part of the underwriting process, and it's normal. Where it talks about, I'm on slide 35, where it talks about the post-selection underwriting process, the insurance company may raise deductibles or cancel coverage altogether if it deems that the claims have been excessive. Many states now require 60 days written notice before canceling a policy, because what was happening beforehand, people would find out 5 days before and they had no time to act. And they also have to be told why they're canceling. And one of the interesting things today is sometimes policies are being canceled because of your retail credit score, because the insurance companies have figured out, because of the way they do their studies, that if you have enough, that if you're a lower credit score and you have a home or an auto, you're more likely to have a claim, and that's again adverse selection. Strange. The loss adjustment process, in the policy, your policy will explain what the loss adjustment policy is and how they're going to pay a claim. And the claims department will handle it. There's usually a representative or a adjuster that will help you with that. And it says the adjusters for property insurance will investigate the loss. They're going to determine whether or not it's a loss that's covered, and they're going to determine what the amount of insurance should be for a maximum loss. Now, there are several steps in this process. We're on slide 37. Step number 1, you have to notify the company of the loss. If you're in a car accident, your house burned down, your loved one died, until someone notifies the insurance company, they have no way of knowing that there's a loss. Usually it can be over the phone, and they'll have it on a recorded line. Someone's going to investigate the loss. Did it really happen or occur? If someone dies, they have a death certificate. If someone's house burnt down, they can send someone to look at it. If someone's had a bad car accident, they can send someone to look at it. If someone's in the hospital, it's easy enough for an insurance company to figure this out. So did the loss really occur? Was it covered under the policy? And was the peril covered under the policy? Step 3, you, the insured or the owner of the policy, have to have a sworn statement. Again, this could usually be done over the phone, saying, this is what happened, and I'm putting in a claim. And then you might have to send in some claim forms and have it notarized. Furthermore, the insurance company will either pay the claim, deny the claim, or tell you what they're going to do. It says that if the claim is denied, it will be because possibly there was no loss. And don't laugh at this. There are people that put in claims all the time so they can see if they can cheat the company. Was the loss covered under the policy? There are times that losses are not covered under a policy. And the other issue is, was the amount of the claim reasonable or unreasonable? I think I said once before that if you have a situation where you have jewelry and your policy, the appraisal says it's worth $10,000 and it's damaged, they may not replace all $10,000 if they can repair it for $2,000. On the other hand, because the appraisal is out of date, it's now going to cost you $18,000 to get it totally replaced. They're only going to pay up to the amount of the appraisal. There are 2 kinds of adjusters, slide 40. 2 kinds of adjusters, independent and public. You should be aware of the difference and the definitions. Independent adjusters contract with the insurance company as their consultants. Typically, they will serve several companies. There are some companies like Allstate, State Farm that have their own, but for the most part, independent will contract with the company. Public adjusters will contact with the individuals and help them settle their claims. If claims are disputed, there's a process of going to arbitration or going to regulators to make sure that you get what you believe you deserve. I had a situation one time where someone called me up because under the additional living expenses, they actually spent more than the policy called for. And the insurance company said, you know, because you waited and took your time to get this thing repaired, we're not going to pay for it forever. You have to get this thing done in a reasonably expedient period of time. Well, they actually went past the amount of time, and the insurance company said, we're no longer paying for your additional living expenses. They filed a complaint, and the complaint was thrown out because the insurance company paid the maximum they were supposed to pay under the policy. That's a disputed claim. The states generally demand that the insurance companies follow certain accounting procedures called statutory accounting, and that's where they're going to talk about admitted assets and non-admitted assets. Claims against the company would be non-admitted. That's where I was talking about the premium unearned. Furniture and it will be non-admitted because there's really not a great market for it. Premium reported only after the risk and when it's earned, and I believe there's a quiz question that asks about this. Life insurance assets typically are invested in bonds and mortgages, and they might be able to have 5% of their investment portfolio in common stock, but usually not more than 5%. And then insurance companies also will use reinsurance companies to monitor their risk. So, and that's explained more in the textbook. The reinsurance companies is a way that the insurance companies can have other companies help support their risk. So we have now gone through tonight's material. I have the supplemental material. I'm going to stop the recording and I'm going to reconvene in about 3 minutes. And I think I have about 25 additional slides to go through. And this is what I'm calling Life Insurance 101. Where is it? Okay. I have 25 slides. It'll probably take about 20 to 25 minutes, and then this will be a good primer to help you better understand the textbook and life insurance and annuities that we're going to be talking about next Monday and Wednesday. So I'm going to turn off the recording, and I will reconvene in about 2 to 3 minutes. Okay, welcome back to the third session for the 19th of February. This is what I'm calling an introduction to life insurance and annuities, or Life Insurance Annuities 101. This is not meant to be everything in the final word, but it is meant to help you understand a little easier life insurance. There are parties to a contract. Number one, we have the insurance company. If you're talking about a life insurance contract, you need an insurance company. That's who's going to guarantee the death claim. We have the owner. The owner is an individual, a trust, the insured himself, who's an individual, a corporation, a charity, any number of things can be an owner. The insured has to be a living, breathing individual with mortality. And the beneficiary is the person or entity that's going to be getting the benefits when they're paid. So this slide, number 2, breaks down on the insured must have life expectancy and have a mortality. The owners can be the insured and is the insured in about 90% of the time, maybe 95% of the time. Somebody else, a spouse, a child, a business partner. It could be a corporation. It can be a trust. Usually, if it's a trust, it's going to be an irrevocable trust. It could be a charity. And the owner should have some beneficial interest in the insured. The beneficiary is done by class. So there's a primary class of beneficiary. Now there can be just one person in the class or one entity like the Howard Sorkin Life Insurance Trust. There can be all of my children as the contingent beneficiaries to share equally per stirpes or per capita. We'll discuss that later. But the beneficiary should not be the insured, because if it's the insured, what happens when the insured dies? It goes into the estate of the beneficiary, which means it may have to go through probate and may have to pay additional taxes. The beneficiary can be a person or a trust or a corporation or a charity, as I mentioned. The insured must have a life expectancy or mortality. And let me explain what per stirpes and per capita mean, because you will cover this again in the estate planning class, but I want you to be very aware of what it means. Per capita means everybody in that class, in that group, will share equally on a percentage or to the survivor. So if you have 5 children, everybody's going to get 20%. If one of the children predeceases you, that 20% will be split up among the 4 survivors, so then each person will get 25%. If a second child predeceases you, the survivors under per capita will get 30%, and the people that passed away, their heirs get nothing. Per stirpes means we are going to distribute the money equally to the survivor or their linear descendants. So that's where you could have a situation where your grandchildren or your great-grandchildren would be able to share in that percentage that was left to your child to begin with. Now again, this is all in the textbook, and I'm just trying to give you some highlights here. It is important that you be aware of the fact as you're doing your reading, and we will discuss this further in Units 7 and 8, that life insurance usually is income tax free if paid to a named beneficiary and the policy is set up correctly. Usually income tax free. However, in addition to income tax, we could have gift taxes. And the gift taxes today are 35%. If the policy is not set up properly, you could make a gift to someone which would generate a 35% gift tax. There might be estate taxes which today are around 40% if your estate is large enough. If you have cash equity in the policy, a whole life, a universal life contract, the equity that's built up grows on a first in, first out basis. So it's the premium dollars you put in first that comes out, and that's called the basis. After the premium dollars you put in first come out, then the gain comes out if you take the money out during your lifetime. If the money is only paid as a death claim, it doesn't really matter how it comes out. Then all that you're concerned about as a death claim is making sure that you're not causing additional unnecessary taxes. Now let me explain in a little more detail. If someone is the insured, let's say Jack is the insured, Jill, his wife, is the owner, and their 5 children are the beneficiaries. And that does happen. Jack is the insured, Jill is the owner, and there are 5 children of the beneficiaries. The idea is the money goes directly to the children. Jill being the owner, the money is out of Jack's estate for federal estate tax purposes because the owner has the rights of ownership, which means you name the beneficiary, change the beneficiary, access the cash value if there is any, access the dividends or change the dividend options if there are any, and you can collateralize the policy or do something with the policy to see to it that it is used for collateral. Those are the rights of ownership. So if Jack is the insured and Jill is the owner and she has the rights of ownership and the children become the beneficiaries, you just made a gift to the children. So the children will have to pay 35% tax, gift tax, on the money they receive. What does this really mean? This means that the children on $1 million policy have just paid $350,000. How can that be avoided? Well, it can be avoided by saying, as an example, maybe have the owner a trust and the trust the beneficiary. And the beneficial interest of the trust will go to the children. It accomplishes the same thing, but it avoids the taxes. Most of the time, the insured and the owner are the same, or the owner and the beneficiary are the same. In the rare circumstances where you have 3 independent entities, that's called the Kaufman rule. One of the other instructors refers to that as the unholy trinity, and that could create extra taxes. Now this does get somewhat confusing, and I want to make sure you understand it because it's a great way to have a test question on an exam. So before I go any further, I'm going to just see if anybody has a question on the taxes. Okay, I don't see any, so I'm going to move on. Somebody trying to give me ask a question? Okay. What is life expectancy? Life expectancy is how long you're going to live based upon your age. Are you a male or female? What is your height, your weight, your other characteristics, and possibly what is your health and or family history? In order to get a life insurance contract, you have to have a mortality or life expectancy, which means you have to be a breathing, living person. We know that if we have a 35-year-old male and we have a 35-year-old female, and let's assume they're both standard risks, the 35-year-old female is going to have a premium for life insurance of about that of a 31-year-old male. There's about a 4-year setback. Now, some companies will allow people to buy life insurance at 20 or 30 times their income. Other companies may restrict it to only 20 times. Some companies are more liberal in their underwriting for smokers or people that are height weight. In other words, if you're 5'9", 180 pounds, you might be considered preferred with one company. 5'9", 200 pounds might be also considered preferred with a different company. Those are the characteristics. Some companies do look at health history. They want to make sure that they look at your health history and your family's health history. When we're thinking of premiums, there are certain items, regardless of the kind of life insurance we're talking about, that are important to consider. Premiums consist of, for life insurance, mortality expense, your life expectancy, plus the loads. What does it cost us to be in business? What does it cost us to pay taxes in our underwriting expenses? Those are loads. Premiums, once we have mortality plus expenses, we can take the earnings out, and that will give us our net premium. Certain insurance companies have higher expenses. Certain insurance companies have higher or lower loads, and they determine, as part of the load, how much profit they want to have in the policy. Term insurance. Term insurance is temporary insurance. Think of it as a box of protection. Think of it as, I only want to worry about my family, my business, the bank getting paid if I get hit by the proverbial bus. But people don't want to talk about death. So insurance companies have figured out we don't talk about death, we talk about face amount. Term insurance can be purchased for 1 year, 5 years, 10 years, all the way out to maybe 30 years. The longer you transfer the risk to the insurance company, the greater the premium, which means if we have a 1-year term insurance contract and it's costing 80 cents per thousand this year, and maybe 3 years from now it's going to be 84 cents per thousand, and 10 years from now it's going to be $1 a thousand, that's a level death benefit. The premium goes up as our mortality increases. On the other hand, it could be if you have a 20-year term, as opposed to being 80 cents per thousand, you might start out at 94 cents per thousand because the insurance company is transferring the risk over 20 years and they're just amortizing it. We have level death benefit term insurance, which means the death benefit stays the same and the premium will go up. We have increasing death benefit insurance, which means, decreasing, which means the death benefit goes down maybe to a amortization schedule and the premium will stay level. I am not a big believer today in a decreasing term because the cost of term insurance is so low, to me it doesn't make sense because you can buy term insurance at a much lower rate. Now I hope this is going to work. I don't know if it's going to work. So, if I am starting out here at age 30 and I'm buying 1-year term, every couple years or every 1 year it might be going higher. That's what the premium is. Now, what do we know about premiums later on? Well, we know that the older I get, the more expensive that premium is going to be. If, on the other hand, I buy a 20-year term, the premium may be here, locking it into for 20 years. If I'm buying a 10-year term, the premium, I'm having a hard time drawing this picture, be like that. A 30-year term might have the premium all the way out to here. So what we're saying is the more risk the insurance company is taking, the greater the risk the insurance company is taking for that term insurance, the more expensive the premium should be, and that just makes sense. On the other hand, if we have a decreasing term contract, the death benefit or the face amount is going to go down a little bit every year per some kind of a schedule. The premium stays the same, but the face amount goes down. So you have to determine what you're looking for. And again, I'm not a big believer in decreasing term anymore, because what I have learned is that decreasing term, for the most part, gives you a false sense of security. Now, I want you to think about this as a 1-cent plan. So if we are going to classify term insurance as what's going to cost per unit of insurance, just think about it as a 1-cent plan. I don't want someone calling up or going and saying, well, my instructor said you can buy insurance for a penny a unit. This is just an example so you can follow what I'm doing. Now, if we are going to turn around, I've already discussed the decreasing. If we're going to turn around and we're going to say, I want to charge you more, you're going to say, if I'm charging you 2 cents per unit, you're going to turn around and say to me, why am I charging you 2 cents per unit? There must be some additional benefits we're going to get. This is going to be called permanent life insurance. It's very important to understand the difference between permanent and term insurance. Permanent life insurance means once you've taken the examination, once the policy is issued, as long as you pay the minimum premium required to keep the policy in force, you'll have a death benefit and never have to take another exam. The mortality charge, like term insurance, uses current mortality. The face amount or the death benefit can be A, level, or B, increasing. It's up to you how you want to do it. A, level, or B, increasing. The values will vary depending on the interest rate. Usually most universal life contracts are either based upon a minimum interest rate and a current interest rate of what the policy is earning. So the minimum interest rate might be 2%, it might currently be paying 3%, or it might be on some index, such as the S&P 500. Sometimes universal life could be an investment product and be classified as a variable universal life policy. The premium here is called unbundled in your textbook, which means every year you're going to be getting a statement that's going to show how much of the premium is for the mortality charge, how much is for the expenses, and how much is being credited. If you look at this as a permanent plan, oops, see if I can get this to work. If you look at this as a permanent plan, you're going to see that the cash or the equity is going to grow as the policy is further out and is maintained. That equity at some point might go all the way up to the face amount where it is here. This is compounding of interest because it's going to start out very small and maybe with none, but as you keep it longer and you make sure you pay the right premiums, because you have flexibility in the premium between a minimum premium, a maximum premium, and a target premium. And the target premium is designed to keep the policy in force at the minimum interest rate that's guaranteed in the contract to say age 65, 70, or age 100. This equity in here, this equity in the policy will grow based upon what you need to be aware of. So, and this equity is your cash, and that's going to grow. Now, permanent life insurance has advantages, but it costs more. Does everybody, any questions so far? Again, this is supposed to be an overview to help you when you read the material. Whole life insurance is going to be the following. I'm going to say the whole life policy is we're going to charge you 3 cents per unit. So if I'm charging you 3 cents per unit, you're going to say to me, the only way you're going to take that as a permanent plan of insurance is if I'm getting more benefits. This is a guaranteed contract. Some companies call it whole life insurance. Some companies call it straight life insurance. Some companies call it whole life, straight life, ordinary life. Once you take the exam, you never need to take another exam, and you are transferring the risk from the insurance company from you to the insurance company forever. What does that mean? That means that the premium is going to have an amortized premium all the way, hypothetically, to age 100. All the way to age 100, because that's going to be considered full life expectancy. Oops. So if you start this policy today, what you have to be aware of is the premium itself is going to be giving you, let's say today, you are 35 years old, and hypothetically, you're going to continue to pay the premium until age 100. That's your full mortality. That doesn't mean you have to pay the premium to age 100. Now, so what we are going to have here is the growth of, the cash, and it's going to be based upon a specified chart in the policy. Everything is guaranteed. So this is something of a plan that you're not going to get a statement at the end of any given year that says how much did they pay for the mortality charge, how much did we pay for the expenses. It's all in the plan. The cash value is going to grow in here, and the longer it goes out on this continuum, the greater the cash value. When I was 18 years old, my father insisted I buy a life insurance contract. I was paying $180 a year of premium for a $10,000 life insurance contract. Now, times were different when I was 18 years old, and $10,000 went a lot further than it went today. Today, I'm still paying on the policy, even though I could have stopped paying 20 years ago, because I'm taking the money and it's going into my account. So I'm putting the money out of my left pocket, sending it to an insurance company, and I send them now because some of the benefits are no longer there for future purchase and waiver of premium. And all of a sudden, if I send them $160, maybe $300 is being increased in the cash value. And the death benefit also is going higher. It started as a $10,000 death benefit, and right now the death benefit is somewhere up here at around $28,000. It's all because of compounding. Whole life, ordinary life, straight life is a conservative item. Some people have referred to it as a insurance policy. It's like a bond because it's going to guarantee how much cash is in there. I have clients that have $50, $60, $80, $100,000 of cash built up in here. Now, for emergency fund, if you remember for the exam, you don't want to use an emergency fund out of the cash because you could cause a problem with the policy. not being available, but you can use it if you really need it for emergencies and opportunities, or retirement income. A limited payment life policy, I'm going to classify this as a 4-cent plan. A 4-cent plan. So if it is, just let me type. A 4-cent plan, the question is, what am I getting that I didn't have before? Well, here is my face amount, but as opposed to having a whole life policy where I'm paying the premium for to age 100, I might pay the premium only to age 65. So if my premium to age 100 is here, sorry, that should be a straight line, I might be paying more, but I'm paying it over a shorter period of time. That's why it's called limited payment life. You're going to pay a higher amount for a shorter period of time. What does that mean? That means when you retire, you no longer have to make the premium payments. The endowment contract, for lack of a better term, I'm going to call this a 5-cent plan. And 5 cent means we're paying 5 cents per unit. $0.05 per unit. What this is saying, and by the way, this is no longer sold since the tax laws changed. There's millions of them on the books. Let's say I have an endowment at age 65. That means the face amount is going to be equal to the amount of cash guaranteed in the policy at age 65. I could have an endowment for 20 years. I could have an endowment at age 100. Oops, sorry. That should be here. Bad angle. So what I'm saying is, if you have an endowment policy and they're no longer sold because the tax laws changed, and we're going to be talking about that in week 7 and 8, the tax laws changed, which means that the government has said this has become an investment, not an insurance policy. So if it's an endowment and you take the money out during your lifetime for income or whatever, or a loan, you're going to pay ordinary income tax on it. So we have a 1-cent plan that's term insurance, the most protection for the least money. We have the 2-cent plan that would be universal life. The 3-cent plan that would be whole life. Most whole life policies pay a dividend. The 4-cent plan would be a limited payment life contract, life paid up at 65, 20 pay life. And the 5-cent plan, which is no longer sold, is the endowment plan. Now, what we have to be aware of is endowments change from an ordinary life insurance contract, where the endowment was first in, first out. It becomes last in, first out if it becomes an endowment. And as we're going to find out in sessions 7 and 8, their policies can become endowments. And if they become endowment, while you're talking about or looking at what happens during your lifetime is where the taxation changes. I want you to pay attention as you're reading the material on modified endowments, because what has happened is a couple of exams ago they asked about 4 or 5 questions on the taxation of modified endowment contracts. And that's when the first in, first out on the internal buildup moves to last in, first out, so the growth is taxed first. Again, I'm going to go over this in more detail, units 7 and 8. Before I move on to annuities, are there any questions? I hope you're finding this beneficial, because I know reading a lot of this material in the textbook gets a little dry. Annuities. There are immediate annuities that are for income today. People that are retired or people that need guaranteed income, that's an immediate annuity. Deferred annuities can be for income later, which means We're going to have fixed annuities. Fixed annuities would be like a CD. We can have a fixed annuity that mirrors an index, just like the universal life contract that mirrors an index. We can have a fixed annuity that's a variable. Annuities are a vehicle where you have tax-deferred growth. And it does matter if the contract is owner-driven or annuitant-driven. Owner-driven means I'm the owner of a contract, my wife can be the annuitant, there's no death benefit claimed and no benefits available to me as the owner until she dies. Annuitant-driven means when the annuitant dies, the death benefits can get paid. And it's also in your textbook. Annuities provide for tax-deferred growth. Tax-deferred growth, which means the money that you would have paid income tax on earlier is now deferred and continues to grow income tax deferred. Most annuities have some kind of a surrender period, just like a CD. I know that certain people dislike annuities and will make big cases against them. There's somebody running ads in the paper saying annuities are horrible, and somebody like Susie Orman says annuities are horrible. But for the right situation, they make a lot of sense because they will guarantee income for life you can't outlive. You have to be aware of what the annuitization factors are, and we will be discussing in Unit 8, I believe, what's called an exclusion allowance. The parties to an annuity contract, where you have, earlier we discussed the parties to a life insurance contract, and we were talking about more insured. Now we're calling them annuitants. And just like sometimes you can have more than one insured, you can have more than one annuitant. It's usually between a husband and a wife. The death benefit of the annuity is different than the death benefit of a life insurance contract. The death benefit of the annuity is not income tax free. It will be income tax free if paid to a spouse and the policy is continued, but it's not income tax free if paid to a child or to somebody else. The annuitant has the same situation in terms of the ownership, who it can be, the beneficiary by class, whether it is primary class, contingent class, per stirpes per capita, and you pay attention to how things are taxed if you take the money out during your lifetime. Even if it's an annuity, which it might be qualified, which means it's an IRA or a 403B, then the money comes out as all taxes ordinary income. You don't get capital gain treatment. Be aware of the fact that the reason for that is the money's never been taxed. And that's why you have to know the difference between an annuity that's classified as qualified or non-qualified. The immediate annuity is for those people that want income today. What you're really doing is you are spending your money that's in the annuity as well as an additional factor for interest and growth. It will guarantee the payment period for a period of time. It can be 5 years, 10 years, 20 years, lifetime. The longer the payment of time for the annuity payment, the less money you're going to be getting because the insurance company is taking more risk. The annuity as is paid will be subject to ordinary income tax, not subject to capital gains. Remember to pay attention to what's called the exclusion allowance when you read it in the textbook, and I will be discussing that in the future. The fixed deferred annuity, you don't get a 1099 every year. The money grows income tax deferred. It's not insured by the FDIC. It is guaranteed by the insurance company. Usually it's single premium, but some companies will allow you to put more deposits in. And it's like a CD in that it grows based upon an interest rate. The indexed annuity will have a minimum guaranteed interest rate, but will grow based upon some index like the S&P 500 or the Dow Jones. And the variable annuity is an investment contract. You need to have a Series 6 or Series 7 securities license to sell it in addition to the insurance license in the state you're in. It is an investment program. It does have investment risk. These are the kind of annuities Susie Orman actually hates because she says the expenses are too high. They may have a guaranteed death benefit. They will, sometimes today they have living benefits which will guarantee income for life based upon a hypothetical rate of return. So in the last half hour, I've tried to give you an overview of annuities and life insurance. I have not seen any questions come through. I hope this clarifies things so when you read the material, it's a little easier for you. Are there any questions? Okay, what I'm going to suggest is the following then. I'm going to suggest that you remember that I'm going to extend the time for the midterm to be to noon on the 26th, not the 24th. So you have an extra couple of days. Please remember that there are a couple questions that actually fall into Unit 6. So some of the material today you'll have. Monday we're going to start with Lesson 7. And we're going to do part of Lesson 7 Monday. And then we're going to do Lesson 8 and finish Lesson 7 a week from Monday. I'm going to stick in the classroom, stay in the classroom in case anybody has any questions they want to answer or ask me offline. You can always email me. And thank you very much. Enjoy the rest of your evening.
From Myrtle Beach, it's nice and 70 degrees here, and I barely made it outside at all because of our meetings. But I'll check tomorrow, and thank you also for the little bit of extension there on the time for the midterm.
Okay.